Hey, Professor Mike. What are we learning today?
Psst. Hey, it's Professor Mike. Shh. Today, I'm going to be telling you about something, but it's classified. Of course, I'm just kidding. Well, I mean, it is classified. But today we're going to be talking about the classified balance sheet. Super fun. Now, why would we want to classify a balance sheet? That's a great question. Financial statements, as we've been talking about all the way through the course, and as we're going to right to the end, they're more useful when they're easier to understand. And they're easier to understand when we group similar types of things together. In this case, similar types of assets and similar types of liabilities. On our classified balance sheet, we may see lots of different classifications. Now, we're only going to see those things if the company has that type of asset or liability. So it could be current assets or current liabilities. Could be long-term investments or non-current liabilities or property, plant, and equipment. Owner's equity is going to be on there always, and maybe intangible assets. We'll talk about what those are, and goodwill. So usually, during current assets, I make a raisin joke because something that looks like a raisin is called a current, but hasn't landed lately, and I feel like maybe it's a generational thing. I know Professor Mike's getting old. So current assets are cash and other assets that are going to be converted to cash within 1 year. Well, it's within an accounting cycle, but we're going to call it for our purposes within 1 year. So you can think of things like cash, because that's already cash, or accounts receivable. That's not cash yet, but we're hoping it's going to be cash soon, right? Inventory, we want to sell that and have that become cash. Short-term investments that we've purchased, or prepaid expenses. As you may recall from our prepaid expenses example in the last unit. We talked about how we bought things ahead of time. Those were assets that were being used up. They're current assets. Next up, we have long-term investments. So these are assets that are longer than that 1 year period. Kind of makes sense as well. Long-term investments. So these are investments in debt or equity that are expected to be held for many years. Not the equity of our company, but the equity of other companies or debt of other companies. They're not readily marketable, and they're not expected to be marketed within the next year. So think about investments in stocks or bonds of another company. For example, long-term notes receivable, or the portion of those long-term notes receivable that aren't receivable within this 1 year. An investment in land held for resale. So a company could buy a piece of land and maybe say they're not using it in operations. They're going to hold on to that land and they're going to resell it. All of these are good examples of long-term investments. Now, not all companies have long-term investments, and that's okay. So if they don't have them, it's not a classification on the balance sheet. But if they do, this is where they go. Next up, we've got property, plant, and equipment, or PP&E. So property, plant, and equipment, similar to the knobs and dials behind me here, are long-lived tangible assets. So tangible means they're things that you can touch, like this clicker. They're used in the business and not intended for sale. So thinking back to that piece of land, let's say that it was actually used in the business. Okay, that would be there. Buildings on that land, pieces of equipment that go into those buildings, vehicles. Anything that's a piece of equipment or property or goes into our plant, all goes here. Another form of assets we have on this classified balance sheet is intangible assets and goodwill. So remember we said something that you can physically touch is tangible. Something that's intangible is just the opposite of that. It's something that you can't actually physically hold on to. So think about something like the McDonald's brand. Everyone around the world knows what that is. Or Starbucks. There's value to that brand, but it's not something you can touch. It's not something you can hold on to. So something like a patent, right? If you had the patent for 5G chips that go into cell phones, for example, that would be worth something. Now the chips are tangible, but the patent itself, the design for those chips, not tangible, it's intellectual property. So all of these intangible assets go into intangible assets, and goodwill. And now a company might not have any intangible assets or goodwill, and if they don't, it doesn't go on the balance sheet. And if they do, it does. Goodwill is a type of intangible asset, and it arises when a company is acquired at a price greater than the fair value of the assets in the company. So for example, if you were able to buy the entire company, Starbucks, you wouldn't just add up all of the assets within the company. There would be something extra, some extra value that you might pay. Now you might not, but if you do, that's goodwill. Let's take a look at a hypothetical company. We've got Highland Cove Resort here, and they've got a trial balance here where they have some assets, some liabilities, and some equity items listed. So if we're looking at this trial balance and we want to identify the current assets, well, they're just right up here. And if we want to identify the long-term investments, we take a look and we see there aren't any, so we wouldn't include those on the balance sheet because there aren't any. Take a look for property, plant, and equipment for PP&E, and we can see that they are right here. And finally, we take a look and see if we can see any intangible assets or goodwill, and for this company, there are none. So again, they wouldn't go on the balance sheet because there aren't any. Moving to the other side of our balance sheet and to the other side of our accounting equation, we have current liabilities. Now these are liabilities in the same way that current assets are assets that we're expecting to turn into cash in the next year. Our current liabilities are liabilities that are expected to be settled within 1 year of the balance sheet date. So that 1 year for current assets is the same as for current liabilities within that 1 year period. So think about something like accounts payable or a note payable that's due within a year. Interest payable, salaries payable, unearned revenue is a good example if we're expecting to earn that revenue within 1 year. And the current portion of our long-term debt. For example, if we have a long-term mortgage within our company, and let's say it's $100,000 and we know we're going to be paying $10,000 back in this year, that current portion of our long-term debt is actually a current liability because it's due within a year. The rest would actually be a non-current liability. And those non-current liabilities are things that are due in longer than a year. So back to that example of a $100,000 loan that we had, if $10,000 was due within a year, well, that's going to be a current liability. The remaining $90,000 would be a non-current liability and go here. Some other things you might think about for non-current liabilities outside of mortgages payable, you might have bonds payable or lease liabilities or deferred income taxes if they're longer term. For our purposes, it's usually going to be something like a mortgage or a loan. If we go back to that trial balance of Highland Cove Resort, we can see, again, coming down the list, take a look, we've got current liabilities right here. And below them, do we have any long-term liabilities, any non-current liabilities? Indeed we do, and they are right here. Now, finally, as we're classifying, we've classified assets into 4 categories, and we've classified our liabilities into 2 categories. Our final category is equity, and for our purposes, this is just going to be under owner's equity. There aren't any other sections you need to add because we're dealing just with proprietorships. So if we take a look again at Highland Cove, we work our way down the list and we can see that we've got capital, drawings, revenues, and expenses. All of those are going to first build an income statement, which leads to a profit or a loss. That gets added to the statement of owner's equity, which eventually leads down to closing owner's equity, and that goes on the balance sheet as equity. Now, we've made statements in the past, we're going to continue to make statements, and that's the process that flows. However, for a classified balance sheet, still just one item for equity, and that is owner's equity. I want to give you a quick note on IFRS versus ASPE. These are 2 different accounting standards within Canada. You have different names for different statements when you're looking at IFRS versus ASPE. In this class, we're focusing on ASPE. So if you're not interested in this, you don't have to worry about it. We're only focusing on ASPE. But IFRS is the International Financial Reporting Standards, whereas ASPE is accounting standards for private enterprises. And since sole proprietors are small enterprises, they tend to fit in that category. Under IFRS, instead of a balance sheet, call it a statement of financial position. Both allow either name, but they're generally called one or the other depending on the accounting standards. And asset classifications are a bit different. And again, since we're not getting into it in this class, you don't have to worry too much about it, but it is in your text. Check it out. Pretty interesting stuff. So what does a classified balance sheet look like? We've taken a look at a trial balance, but now that we've classified our assets and our liabilities, how do they look on a balance sheet? Well, here is an example of a classified balance sheet. You can see instead of listing all of our assets all jumbled together, we have them broken down into, in this case, two classifications because the company doesn't have long-term investments and it doesn't have intangibles or goodwill. So we first have current assets listed in liquidity order, total current assets. Then we drop down to PP&E, listed less accumulated depreciation, what we learned about in our last unit. Very interesting stuff. The only contra asset that we're learning about in this class. Very cool. And moving down to total assets. We then move into liabilities, and you can see it's broken down into current liabilities and long-term liabilities. So we have those two classifications broken out, and finally our owner's capital. So here's an example of what a balance sheet without proper headings might look like. The form of balance sheet is going to depend on the company that you work for or work within, but it's important you understand the different classifications and how they're broken down. I hope this has really helped you with your classified balance sheet, and looking forward to seeing you in the next unit. Thanks a lot. Bye.